Welcome, options traders. I'm often speaking with clients about different option strategies, and one of the most commonly hot topics that comes up is managing the risk. And everybody says, well, now that I've got this money into this position, I need to manage the risk. And what I find, even though that's a topic we certainly want to address, most people are either managing risk that isn't there, or they're just managing risk that they should be living with. And I know that might sound odd, but in the world of financial risk management, that is, in many cases, going to be our best course of action. So you have to understand that when you're dealing with risk management, you have four basic choices. You can either avoid the risk, you can accept it, you can transfer it to somebody else, or maybe just reduce it. So how do we decide among these four choices? Well, here's a little table you can think of, and notice on this scale right here, we have probability. So going up in this direction is high probability, and down here is low probability. Not going to happen all that often. Across the horizontal, we have severity. How bad is it going to hurt you? Over on the left is low severity, and to the right is high severity. So how can we make our decisions? Well, notice that if we are dealing with a situation that is low severity, not going to hurt us too bad, but it has a high probability, it puts us in this box right here. We should either accept it and just live with it, or there might be some times that we want to reduce it. But for the most part, we're not really going to try to manage any type of risk here. Why? It's not all that severe, and it has a high probability of happening. So if we know it's going to happen and it's not going to hurt all that bad, there's no reason we should say I need to insure it or manage the risk. If we drop down to this box here, we are dealing with situations that are low severity and low probability. So probably not going to happen, and if they do, they're certainly not going to hurt. In these cases, the decision is easy. Just live with it, accept it. On the other hand, if we are dealing with something that is high probability and it's high severity, you're going to be in this upper right-hand box. This is what you want to avoid. Don't go there. That's your best course of risk management. But yet a lot of times people will enter a position and they'll say, now I want to manage the risk. So a great example might be somebody says, well, I think this stock is going higher, so let me dump my entire account into a short-term at-the-money option. Well, that's got a high probability of expiring worthless. And it's going to hurt pretty bad. You're going to blow out your entire account. Don't go there. Just avoid it. Don't enter the strategy and then say, well, now I need to manage the risk. You might not get the opportunity. And then finally, down here, this is where the action is, this bottom right. These are situations that are high severity, but they're low probability. So for me, down here in Florida, for example, we have hurricane insurance. If your house gets swept away, it's going to be high severity. But it doesn't really happen all that often. It's still a very low probability event. This is a perfect situation for insurance. Let's transfer it to somebody else who can bear that risk. And we might share in it a little bit by accepting a deductible. But it's this bottom right-hand corner where your risk management skills need to kick in. Things that are high severity but low probability. Now, this might sound easy on paper, but there's a big problem when it comes to trading. And that is that people are just notoriously risk averse, which simply means that they do not like taking losses at all. And in fact, they despise losses so bad that they will start overstepping their risk boundaries to try to not end up with a loss. And so this is why so many times people get into strategies and start managing risk that just simply isn't there. Let me give you a perfect example outside of the world of options. So here's a screenshot from Office Depot's website, and you can see here's a verbatim flash drive, 2 GB. They sell for $9. But if you click on Add to Cart, you're going to get this little pop-up menu. Would you like to add protection? Are you kidding me? No, they're not. Down here, 2-year protection plan, $2. You can get a 2-year accidental plan for $7. Accidental plan means regardless of how it breaks, Whether you lose it, sit on it, spill coffee on it, doesn't matter. But you're spending $7, you're almost repurchasing the item again, and yet you're not even sure you're going to need the protection. This is not something that's high severity, and it is high probability. But yet people want to protect their investments. That's what they'll always try to sell you at the register. Would you like to protect your investment? And notice that this is not some fly-by-night insurance company. Look right here. This is Allstate. Why does this work? Because people are risk averse. And it's this entire behavior that causes people to try and manage risk that just simply isn't there. So here's an example, one that I was actually speaking to a client about, and he was looking at a stock that was trading for $205 and was considering the 205 call for 8. Well, if you buy the call for 8 instead of $205 for the stock, he's already knocked off 96% of the amount that he could lose. But then he was looking at entering a vertical spread by selling the 210 strike, which was trading for about 6. So if he spends 8 and collects 6, he has the 205 210 vertical for a cost of 2. Now he's knocked off 99% of that stock's cost. And this is his profit and loss diagram at expiration. Notice if the stock is below 205, maximum he can lose is 2. That's it. If it's above 210, maximum he can make is 3. But then his next question was, how do I manage the risk? Well, there just isn't any risk here to manage. You've knocked off 99% of that stock's cost. Let it run. Give your outlook some time to develop. What you don't want to do is to say, well, now that I've got $2 into it, if it falls to $1.50, I want to sell it. Let me put a stop order on it. You're trying to manage risk that just simply shouldn't be managed. So here's one of the problems with putting a stop on a position like this, or just stops in general, and I've talked about using stops, the difference between a path-dependent and a time-dependent tool. It's another video right here in this forum. But for example, let's say that we have the S&P 500 and we place a stop at this level, whatever this level is right here, but we buy our stock right here, or maybe this vertical spread position. And we see that it dips down here and we get stopped out. Well, yeah, you might feel like a genius at that moment, but that's because you're comparing it at exactly the moment when you can see it's not working. But the movie's not over yet. This position still might have 30 days left or 60 days left. But because you were so risk averse and weren't happy with knocking off 99% of that cost, you now got triggered out, and then you end up missing this. And of course, if it had dipped down in here, it doesn't matter. It still keeps you in the position. Unlike a stop order, the options will keep you in it. And see, now I can give myself time for my outlook to unfold. But if I'm so worried about managing risk that just shouldn't be managed, what's going to happen is you're going to get yourself triggered out of nearly every single position, and you're going to miss the very profits that you should have captured. So the main thing is that when you're setting up your positions, think a little bit about risk management and when you should use it. And most of all, manage where the risk is, not where you think it ought to be. For those who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and a brand new strategy lab for 2019 at optionsatoz.com. Also, please join us on the Facebook trading group Options A to Z, and you can find a link in the description below.